Hi team, and welcome to another video for tutoring. Today we are going to be going over part 2 of provisions and options. So today's video is going to be about options, right? Options are choices that we have to make when it comes to being paid out, right? It's going to be settlement options, dividend options. Just how do you want to receive any sort of money coming from this policy? Okay, so I'm going to go ahead and share my screen. If you haven't seen the first part of this video, please make sure to go back and see that video. Okay. So let me go ahead and get in here. Alrighty, so when it comes to policy loans, okay, when it comes to policy loans, first thing that we need to know is that it has nothing to do with term life insurance. Okay, so term life insurance does not allow policy loans. Okay, because that is pure insurance. It's strictly insurance. There is no savings, there's no cash value attached to it. So policy loan options are found only in policies with cash value. Okay, so whole life, universal life, variable policies, anything that is not term can have a cash value, therefore would have some type of policy loan option that would need to be chosen at some point or time. Okay. The policy owner is entitled to borrow an amount equal to the available cash value. So if your cash value is at, 10 grand, you're able to borrow against it. And we have the right to do that. Now, there's a couple of things that the insurance company can do. They can defer our request, right? They can have us wait up to 6 months in order to get a loan on our own money. Okay. However, I mean, they can have us wait that long, but it's only if it's something that is for like something other than paying for our policy. So if let's just say that I have a whole life policy and this month I can't make the payment, right? I can't make the payment. So I would like them to use my cash value in order to pay this month's premium. So for that kind of a request, they are not allowed to defer it. They need to make that loan push through right away, right? So there's no hold time on that type of request. However, if you're just pulling out of your cash value, they can have us wait up to 6 months. There can be a 6-month waiting period to get our money, okay? So know that. The policy will not lapse with an outstanding policy loan unless the amount of the loan and interest exceeds the available cash value. What does this statement mean? This means that yes, we can borrow against our cash value. However, if we borrow all of our money, right, including the interest that they are going to charge us, right, our cash value then will be zero. So the policy is going to forfeit. It's going to close. Okay, so this is why it's not good for people to borrow against their life insurance policies. These policies are not very good anyway, but like I said, to try to be fair, right, for our test, we just have to learn the basics. So when it comes to cash value, yes, you can borrow from it, but they are going to charge you interest on your own money. You do have to pay it back. If it is not paid back by the time you pass away, they will take it from your death benefit. Okay. And they can defer it. They can make you wait 6 months to get your own money. Okay. So the insurance company, if our policy, let's just say we borrowed, and now we don't have any more cash value, right? What the insurance company must do before terminating our policy is they must provide us a 30-day written notice. Okay, meaning it's going to come in the mail. I don't know about you guys, but how many people really check their mail? No. I've got a stack this big at my house, you know, like it's a very un thoughtful way to cancel your policy. They just send you a letter stating, hey, your cash value has been depleted. Unfortunately, this, X's out your contract unless such and such happens. Okay. So just know for this that they would notify us in writing 30 days in advance to our policy closing out. Okay. All right. So, how do we know how much we can borrow from? Right? It's called a loan value. Okay. How much value do you have in that account? So, your loan value is your cash value minus any unpaid loans and interest. Okay. So, your cash value minus any unpaid loans and interest. Now, let's see if I have this is going to be easy, right? You might get a question on your test about something like this, and it's simple. It's so simple, but they try to word it in a way that's confusing, right? So let's just say that we have $50,000 in our, or we had $50,000 in our cash value account, right? That's what's in our savings. And we borrow 30,000 of it, right? This leaves us 20,000 in the account. Let's just say that there was 5,000 in fees. We're going to minus the 5,000 in fees, right? Fees and interest. This only leaves us 15,000 in loan value. Okay. All that means is we're not going to be able to continuously pull out of this account. Just like any other account, you can't just keep pulling and pulling and pulling. You're only entitled to what you haven't borrowed and what hasn't been claimed to interest. Okay. So your loan value is the amount of cash value that you had minus any unpaid loans minus any interest or plus any interest. Okay. So pretty standard. All right. And then earlier I talked about automatic premium loans. Okay. So like I said, if we have a whole life policy and we need to pay this month's premium, we don't have the funds to pay this month's premium. What's going to allow the company to do that is called an automatic premium loan. Okay. This loan is going to prevent an unintentional lapse of the policy. That's what they call it, okay? So automatic premium loans work like this. Sometimes people just forget to pay. Sometimes they switch their bank information. There's things that go into it that they don't want their policy to lapse, but they didn't pay, right? So an automatic premium loan provision is not required, but is commonly added to contracts with cash value at no additional charge. How nice of them. This is a special type of loan that prevents unintentional lapse of a policy. Okay, that is important to know. Automatic premium loans prevent unintentional lapses of policies, okay, due to non-payment of premium. For example, a loan against the policy cash value for the amount of premium due is automatically generated by the insurer when the policy owner has not paid this premium by the end of that grace period. Okay, it's automatically going to kick in. It's going to go to your savings and it's going to take that premium out. Okay. Normally, there's a 6-month waiting period for Normally, there's a 6-month waiting period for any loans. But when it comes to an automatic premium loan, there is not. It has to be honored immediately. Okay? It must be honored immediately. So this provision here allows the company, especially later on in life, to come through the back end and take from our savings. Okay, so keep that in mind when you become licensed. That's a big thing that we deal with, that we see. Okay. But automatic premium loans prevent unintentional lapse of the policy. Okay. Perfect. Now we're going to get into non-forfeiture options. Okay. So non-forfeiture options are decisions that have to be made about how this cash value is going to be used, is going to be protected, what's going to happen with the money. Okay, that's what options is. It has to do with money, has to do with choices. Okay. The different choices available to them are categorized as non-forfeiture options, dividend options, and settlement options. Okay. Now, before we get into this, just know that literally all three of those, non-forfeiture, dividend options, and settlement options, they all are pretty much the same options. Okay. They just work in different ways, or they're for different sums of money. Okay. So they might be worded slightly different, but they're all going to have the same layout. They're going to have a cash option, right? They're going to have some type of savings option or interest. They're going to have like conversion option, and they're going to have like a 1-year term. So we're going to go over them. I'm going to go slowly through the first one, but then we're going to kind of go through the other ones kind of quickly because they all work the same. They all work the same. So once we kind of get that idea of what they mean, the rest will be very much easier, okay? So because permanent life policies, such as whole life, have cash values, certain guarantees are built into the policy that cannot be forfeited, right? Non-forfeiture means we cannot forfeit it by the policy owner. These guarantees, known as non-forfeiture values or options, are required by state to be included in this policy. A table showing the non-forfeiture values for a minimum of a period of 20 years must be included in the policy. Okay, I'm going to show you guys what that looks like, and we do use this. So when you're licensed, you'll get kind of, when you replace cash value, you'll see this. So keep that in mind. The policy owner chooses one of the following cash non-forfeiture options: cash surrender value, reduced paid up insurance, or extended term. So they do give you several options, okay? So first one is the cash surrender value. Okay, the policy owner simply surrenders the policy for the current cash value at the time when the coverage is no longer needed or affordable. So they're just going to call, they're going to say, hey, I would like to forfeit my policy, I would like to cancel, and then they are going to get that sum of money in a cash payment. Okay, so upon the receipt of this cash surrender, there is no more coverage. The coverage ends. Okay. They are no longer covered. And then any excess premium or any excess funds, right? Things that have not been taxed already are going to be seen as taxable ordinary income. Okay. Once this option is selected, like I said, there is no more coverage, right? And a surrender charge or a fee is normally applied as well. Okay, they're not just going to let you surrender and that's it. They will kick in a surrender charge or a fee when this person surrenders ahead of time, like before they're supposed to. Okay, so the second one is extended term. Extended term is going to be when the insurer uses this policy cash value to convert term insurance for the same face amount as the former policy. Okay, face amount is death benefit. So Let's just say we have a whole life policy and it's not affordable for us anymore. We can choose extended term. What it's going to do is it's going to give us a term policy. It'll purchase this term policy with our cash value for the same amount death benefit as our other policy. So if we had a policy for $50,000 and we chose extended term, it's going to switch us from whole life $50,000 to term $50,000. Okay. Now the face amount is going to be the same, but the length of time is going to be however much we can afford with that cash value. Okay, so that cash value, that money that was sitting in our savings is going to purchase a new term for as long as we can afford for the same death benefit, for the same face amount. Okay. This is the automatic option. Okay, there's always going to be like an automatic option of all of these, of all three options. There's going to be an automatic one, and this one in this case is the automatic option. Okay. Next one is reduced paid up insurance. So this one is when it converts over to term, right? It's going to be the term option. Reduced paid up is going to be the whole life option. So your key to remembering that it's not a term policy for this one is paid up. Okay. Under this option, the policy's cash value is going to be used by the insurer as a single premium to purchase a completely paid up permanent policy. Okay. At a reduced face amount, which is death benefit. So with this option, we are converting to a whole life policy that'll go our whole life until death or age 100. But the face amount, the death benefit is going to be much, much lower. Okay. So the other one that we were talking about, extended term, is talking about a term policy, meaning only 10, 20, 30 years, whatever it can afford with that cash value. For the paid up, reduced death benefit, paid up option, this is going to get us a reduced death benefit for a whole life policy that will cover us until age 100 or until death. Okay. And this is that table that they were talking about, okay? So every year that our policy goes, right, on and on and on, or any year that a cash value policy goes on, their value of it goes up, okay? So here we have year one. If we were to cancel year one, right? Year one, we would get no money back. We're not getting anything out of our cash value. Remember too that those policies keep your savings for the first 3 years is what they had said, right? So this is not necessarily correct, but it's just like to give us an idea. Let's just say we cancel on year 5, right? If we chose the cash option, right? We would get $1,550 back. With reduced paid up, right? It's going to give us an idea of how many years of how much insurance we would be getting. Okay. So this right here, this table here, normally it doesn't have this. It only has this. It'll show like what, if you were to cancel, what you are owed, basically, right? What you have promised to you. All right. Now we're going to talk about dividend options. So non-forfeiture options has to do with the cash value, okay, of a policy. Dividend options have to do with dividends. So dividends are only given to participating policies. Okay, what does participating mean? Participating means that it is participating in the market. Okay, so it has ties to the market. These indexed universal life policies, anything that is tied, the variable life, right? Anything that is tied to the market, you're going to have these dividend options. Dividend options are basically saying, what do you want done with the excess funds, which are dividends? Okay, so dividends are a return of excess premiums paid. Okay, they are not taxable to they are not taxable. They're tax-free because you already paid your dividend. Okay, what happens is with variable policies or participating policies, you pay I think they call it a charged up or a stacked premium, right? You pay a higher premium in the front, okay, just in case that those funds are needed. So you pay a premium at the end of the year. If there is any excess or unused premiums that you paid, if there's money that is not allocated for, right, there's excess, it is going to get returned to you in the form of a dividend. Okay, so dividends are not guaranteed, right? Not guaranteed. And they are also not taxable. Okay, and they are only for participating policies. Know those things. Okay. When it comes to options for what we want to do with the dividends, it's pretty much the same. Okay, well, these ones are a little different, but they have the same elements in it. So first one is cash payments. The insurer simply will send the policy owner a check in the amount of this declared dividend. Okay, usually annually. Like I said, they'll wait until the end of the year. Whatever is not used is excess premium. It'll get sent back to you. Next one is reduction of premium. It's exactly what it sounds like. You will take this dividend and you will apply it to next year's premiums, and it will bring your premium down slightly. Okay, so the insurer uses the dividend to reduce the next year's premium. Okay, that's what reduction of premium is. Next one is accumulation at interest. When you accumulate something, you hold it in, you keep it. When we accumulate money, we save money. Okay, so accumulation at interest means that the insurance company is simply going to hold on to this dividend for you in a separate account where it can accumulate interest. It can build, it can grow. Okay, so the interest is always taxable. Any growth, any built money, right, that we did not pay for, that we did not pay taxes on yet, is going to be taxable. Okay, any growth that happens in our account, right, we only put 5,000 in, but now the account is at 15, that 10,000 is taxable. Okay, so anything that hasn't been paid taxes on is always going to need to be paid taxes on. It's like the rule. The government wants their money. So accumulation and interest, okay, like I said, they're going to retain this dividend for us and they're going to save it and apply interest to it. Then we have paid up additions, okay? So paid up is going to automatically tell you that this is talking about a paid up policy or a whole life policy, okay? Be it as it may be so tiny, right? It might be just a little bit. Every year that you do this is going to add and add and add to the amount that you had. So the dividends are used in the paid up additions option as a single premium policy in addition to the face amount to the permanent policy, okay? Here we go, back to this. Let's just say that our policy is worth $100,000 and we get a dividend and we choose paid up additions. This is a whole life policy, by the way. We choose paid up additions and it gives us an extra 2,000, right? So plus 2,000. Now we are worth, or our policy is worth $102,000. But if we continue to do this over and over and over again, over and over and over every year with our dividend, then our value of our policy, our death benefit, is growing and growing and growing on its own because we're stacking, right? We're putting more policies and more policies and more baby policies underneath our main policy. Okay, so paid up additions are single premium policies in addition to the face amount of this permanent policy. No new separate policies are issued. However, each of these small single premium payments will increase the death benefit of this original policy by whatever amount the dividend will buy, okay, for however much we're able to purchase. In addition, each of these paid up policies will accumulate cash value and pay dividends as well. So it's kind of like a snowball effect, okay? The amount of additional coverage that can be purchased with this dividend is based on the insured's attained age and the time that the dividend is declared. Okay, so they're only going to give you, however much you can buy is however much it's going to increase, okay? If the policy did not choose the dividend option, right, if they don't make a choice for any of these, the dividend option will be automatically used as paid up additions. Okay, if they don't choose for their dividends to be sent in cash to them, paid up additions is going to be the automatic option for this one. Okay, so the last one, the automatic option, was the term, right? For this one, the automatic option is going to be the paid up additions, okay? And then lastly, it's called a 1-year term. So the insurance company uses the dividend to purchase additional insurance in the form of a 1-year term insurance that will increase the overall death benefit, but only for that 1 year. So this is a good option because it gives you more coverage right away, rather than doing these little baby paid up additions that slowly increase your death benefit. You're able to just purchase a bigger amount, maybe like 50,000, right? To push up that death benefit, but it only is for that 1 year. At the end of that 1 year, there's no more additional coverage. You would have to use your dividend again and purchase additional coverage. So 1-year term insurance policy, it'll be added on, but it will only last that 1 year. This will give you the most coverage, right, for that 1 year, but it's not going to be for your whole life. So keep that in mind. All right. Then we have settlement options, okay? Settlement options, right, are methods that are used to pay death benefits to a beneficiary upon the insured's death, okay? Or to pay the endowment benefit if the insured lives to endowment date. Endowment date, like I said, is age 100, okay? So settlement options are different than dividend options. Even though they work the same, when we're hearing about them, when we're talking about them, we need to know, okay, this is talking about a death benefit being paid out, right? Dividends don't have to do with death benefits. They have to do with dividends, right? Non-forfeiture values does not have to do with death benefits. It has to do with cash value. So you need to know that difference, okay? If the policy owner may select a settlement option at the time of policy application, but they may also change that option at any time during the life of this insured. Okay. Once selected by the policy owner, though, the settlement option cannot be changed by the beneficiary. So let's just say that this insured person passes away and the insured picks a certain option, right? Let's just say it's periodic payments. The beneficiary can't go, oh, no, I want this in lump sum form. No. It's whatever the insured chose, okay? But if the policy owner hasn't selected an option, like they didn't choose anything, then the beneficiary can choose at that point, okay? All right. Settlement options are only triggered or started, right? Triggered means started by the insured's death or age 100. There's no other reason that a settlement option would be made, okay? So the first one is cash payment. Obviously, cash payment is going to be when the insured passes away. This contract is designed to pay the proceeds in cash, called lump sum. Lump sum means one large payment, okay? Unless the recipient chooses a different mode of settlement, this is going to be the automatic option, okay? This is the automatic option when it comes to insurance. Next one is called life income option, okay? It is exactly what it sounds like. So the life income option, also known as straight life, provides the recipient, right, the beneficiary, with an income that they cannot outlive, okay? Installment payments are guaranteed for as long as this recipient lives. It does not matter how long they live. They will receive payments until the day they die. Okay, this is called straight life income option. This is how it gets paid out. It's just going to pay the person until they die. Now, this is not done by the insurance company. Well, it is, but it's actually an annuity that does that. Okay, it's not the contract. The contract just pays out, gets transferred to an annuity, and the annuities continue to pay you until the day you die. So this is why we get our life insurance license and annuity, right? Those two things go together. So we're going to be learning about annuities, not next chapter, but the chapter after. Annuities are very easy to understand once you understand them. So once someone really explains them to you, you're like, oh, that makes sense. But it always sounds like they're talking about life insurance, okay? You have to understand that anything that's going to be periodic payments or continued payments or periodic payments, anything that's going to spread that money out, this is an annuity doing that. It's not the life insurance policy itself, okay? The life insurance policy is strictly supposed to cover if a death occurs. What happens after has to do with finances. So just keep in mind for your test, when they're talking about that, you need to understand that it's an annuity. It's being paid out to a recipient through an account, okay? All right. So with this income, right, life income option, with this straight life option, like I said, it is done through an annuity. So the amount of each installment paid is based on this recipient's life expectancy. So they need to know who is receiving the money. This also means that it has to be a natural born person to choose this option. Okay, it can't be a company, can't be a business, because you need a life expectancy for annuities, right? For the annuitant, they need to know how old this person is, how long they expect them to live, because they are going to be receiving these payments for however long, okay? If the beneficiary lives for a very long time, right, the payments may exceed the total principal, meaning the money that was there originally. However, if the beneficiary dies shortly after starting to receive these installments, the balance of this account, of this payment, right, the principal is forfeited to the insurance company because it's only meant to pay one person's life. Okay, it doesn't roll over. There's other options when it comes to that. So for straight life, think of one person's straight life. It is going to pay that one person until the day they die. Okay? Insurers make options available which provide at least a partial guarantee that some or all of these proceeds would be paid out. With each of these guarantees, though, the installment decreases. With any kind of promises or guarantees, the insurance company is going to lower the amount that you're receiving. Okay. And all these know this boxes, we want to know them for our test. Okay. So under life income, straight life, right? Under this settlement option, the recipient cannot outlive the benefit payments. They will be paid until the day they die. Okay. All right. Now, when it comes to these options, right, of getting paid out, there are separate options. So straight life only pays one person until the day they die, right? Single life option can provide a single beneficiary income for the rest of their life. Upon the death of this beneficiary, the payments stop. Okay, that's what we were just talking about, right? One single life. However, there are joint and survivor options as well. So we talked about joint and survivor in the last chapter. The life income settlement option that says joint and survivor. This guarantees an income for two or more recipients as long as they live. Okay? Most contracts providing that the surviving recipient will receive a reduced payment after the first recipient dies. Okay? Now, and the most common one, like I said, and we'll want to know these, the most commonly used reduced option is going to be written like this: joint and half survivor, or joint and 2/3 survivor. What does this mean? Okay, let's say we have John and Mary again, right? Remember that this is an annuity. So let's say John and Mary, their mother dies. John and Mary are receiving payments, right? $50 and $50. Okay, that's really bad. But whatever, $50 and $50, John and Mary, right? When John passes away, boom. If it's joint and half survivor, right? The survivor is only going to receive half of what they were originally getting with two. Okay? So John and Mary were receiving $100 together. When John passes away, boom. When you have joint half survivor, right? The settlement option is life income joint and half survivor. Mary is only receiving 50%, half. The other one is joint and 2/3 survivor. Okay? John and Mary, they're receiving payments of, I can't do math, so I'm not going to do this, but $100, right? When John passes away, boom, Mary still receives 2/3 of what they were receiving, whatever 2/3 is of 100. You don't need to be super smart to have your life insurance policy. I mean, your life insurance license. You just need to get good at a couple of things, okay? So 2/3 survivor, they will only receive 2/3 of what they were originally getting with the two, okay? So, let me see. Okay. So this option is commonly selected by a policy owner who wants to protect two or more beneficiaries, such as elderly parents, right? Unless a period certain option is also chosen, right? And we're going to talk about that right now. As the life income option, there is no guarantee that all of the life insurance proceeds will be paid out if the beneficiaries die shortly after the installments begin. This option guarantees, however, an income for the lives of all beneficiaries. So joint and survivor is going to cover the people for as long as they'll live. But like I said, there's no guarantee that all of this money will get paid out. Same with the life settlement option, the first one, the single life settlement option. All right. Next one is life refund. Life refund income settlement option comes in either a cash refund from a cash refund form or an installment refund form. Both options guarantee that the total annuity fund will be paid out to the annuitant or the beneficiary. Okay. The difference between the two options is that under the cash refund option, if the annuitant dies before the annuity fund is depleted, a lump sum settlement is going to be paid out to the annuitant or whoever is the second person in line. Okay. While under installment refund option, the beneficiary would receive the remaining funds in the form of continued annuity payments. So just basically, the difference between cash refund and installment refund is that whenever you see cash, you know they're talking about a lump sum amount. Installment means installments, right? Just like you pay installments for like a car, you pay monthly, it's going to be the same thing. They're going to pay you out that money, but it's going to be in periodic payments. Okay. All right. Now we're going to talk about that period certain. So the last one is called life with period certain. This is the one, if I was going to choose an option, I would definitely choose this one because it guarantees that all of the money will be paid out to someone. Okay, I don't want my money going back to the bank. Makes no sense, right? So under the life income with period certain option, the recipient is provided the best of both worlds in terms of lifetime income and guaranteed installment periods, meaning protection that they're not going to lose their money. Not only are the payments guaranteed for the lifetime of the recipient, but there is also a specified period of time that is guaranteed. For example, a life income 10 years period certain option would provide the recipient with income for as long as they live. And if the recipient dies shortly after, right, this annuity will be paid out to someone else for 10 years, right? Certain. So like guaranteed 10 years. Okay. This one, like I said, the installments might be smaller, but at least you know that it's all getting paid out. Okay. So life with period certain. So just think period certain is a certain period of time. Like it's a set period of time. So you'll see life with periods 10 years certain, right? 20 years certain, whatever that is, 5 years certain. You'll know that that is the period of time that it will continue to pay someone out, even if this person passes away prematurely. All right. Now we have the interest only option. So with the interest only option, the insurance company is going to retain these policy proceeds. This is not an actual option. This is a temporary option while they figure out what's going to happen with this money. Okay. So the insurance company keeps these policy proceeds and pays interest on the proceeds to the recipient or the beneficiary at regular intervals, like monthly, quarterly, semi-annually, annually, whatever's chosen. The insurer usually guarantees a certain rate of interest and will often pay that interest in excess of the guaranteed rate. Okay. The interest option is considered a temporary option since the proceeds are retained by the insurance company. Okay. They're going to keep it until some later point when the proceeds are paid out in a lump sum or paid under one of the other settlement options. So like I said, they're only keeping it until the annuity is set or until another option is chosen. They're not going to continue to just do this whole interest thing. Like I said, the insurance company is not in the business of saving that money. They're not there. They are not the ones that do the annuity, right? So whenever we're talking about periodic payments or saving, right, this is an annuity, not the life insurance. Next, we have fixed period installments. Okay, and I know these are a lot. For the settlement options, there's a lot, but we just need to go through and know the basics of all of them because they ask you scenarios on your test, and you're going to see that on your practice tests. When you take those practice tests, you'll see questions that are just like it. They're going to give you scenarios, and you need to choose which option it's talking about. Okay. So under the fixed period installment option, also called period certain, right? A specified period of years is selected and equal installments are paid to this recipient. The payments will continue over this specified period of time, even if the recipient dies before the end of that period. In the event of the recipient's death, the payments would continue to a beneficiary. The size of each installment is determined by the amount of principal that's being paid out, by guaranteed interest, and length of the period that's selected. The longer the period selected, the smaller each installment will be. This option does not guarantee income for the rest of the life of the beneficiary like the other ones do. However, it does guarantee that the entire amount will be distributed. Okay, so let's just say it was me and I chose a 20-year period certain. I will be paid for 20 years, okay? And how much is based off of how much money I have in my account, what the interest looks like, and then how long my period is, like 20 years, right? So they're going to pay me in that way. Fixed period is going to be a fixed period of time. If I outlive this money, too bad. If I die ahead of time, if I die too early, this money will be paid out to a secondary person. Okay, so there's that. And then we have fixed amount installments. It's the opposite, right? It's the same but opposite. So the fixed amount installment option pays a fixed specified amount in installments until the proceeds are exhausted, okay? Meaning that account is empty. This is for someone who's like, hey, I need $3,000 a month from this annuity, okay? This annuity will pay them $3,000 a month until there's no more money, okay? The recipient selects a specified fixed dollar amount to be paid until the proceeds are all gone. If the beneficiary dies before the proceeds are exhausted, installments will continue to be paid to a contingent beneficiary until all proceeds have been paid out. With this option, the size of each installment will determine how long the benefits will be received, right? If I'm choosing $10,000 a month, it's obviously going to only pay me for a certain smaller amount of time. If I make it a smaller one, like $1,500 or $3,000, it's going to be able to pay me longer because that money will last longer, okay? As with fixed period option, this option does not guarantee the payments for life, but it does guarantee that all of the proceeds will be paid out, okay? And then here, they just break it down for you. What are the non-forfeiture options? What are the dividend options? What are the settlement options, okay? And then we have our chapter recap. Please use this to study, guys. It's an amazing tool that everybody has. This is like a baby study guide. So make sure that we're taking our quizzes. right? That we're taking our practice exams, which is, there's two types of practice exams on your UCAN Pass. We want to be taking those so often because we need to look at the scores. As an RVP, we need to be looking at when you're ready to test, right? And if we're not seeing that you're getting 80s on the practice exams, we don't want to throw you in to go and test, because we want to make sure that we're all successful. So if you're having trouble in certain areas, it will tell you on your practice test, like more studying needed on chapter 3, more study needed on chapter 1, basic insurance concepts and principles, more insurance needed on or more studying needed on insurance basics, right? So please keep in mind that we need to be on top of that. Go back and study those areas and make sure that you're studying your incorrect answers on your practice tests as well, because if we're not correcting ourselves, then our scores are just going to keep on going down, 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 right? If we think something's right and it's wrong, we're just reinforcing it. So we don't want to do that. We want to make sure that we know the correct answer, that we are corrected right away. So you need to make sure to study your incorrect answers or take the practice exam that corrects you instantly. So other than that, guys, if you have any questions, please reach out to your upline, to your RVP. I hope these videos are helping you. Let's make sure to get all of our quizzes in. Let's make sure to finish all of our hours, and get that test scheduled as soon as possible. Have a good one.